banned are all pharma names. Other than that, NTPC, which has had a couple of brokerage upgrades, that continues to see traction, 1.3% higher there. Bajaj Finance is still holding out. Trent is higher by 1%. And L&T is also somewhat resilient in the market. What's not looking good? Bajaj Auto. That's down 3% right now. And technology, of course, is taking a whack. So TCS, Infosys, HCL, Wipro, all of them down. And even some of the globally exposed companies, like a Tata Motors, for instance, that's down about 2%. Of course, it's a sentimental reaction that you're seeing. Other than that, there's weakness in a Hero MotoCorp, in a Hindalco, in a Bharti, and M&M as well. But again, no big damage other than IT.
Yep, no big damage other than IT. Taimur Baig joins us. Let's take our conversation forward. Taimur, always nice to have you back on ET now. Thank you for joining us. Now, Taimur, if I analyze the impact of tariff, the old school way, which is what classic economic theory is, tariff means higher inflation. Higher inflation means slower growth. Slower growth in US is bad for rest of the world. So are we in for a classic play out of a old school economics playbook where economies will contract, US will slow down, and we are in for a stagflation in coming months?
Stagflation light, most likely in the next couple of quarters. We will probably see, starting with the US, inflation tick up. Already there are signs of producers looking at input and output prices and saying that their input prices are rising and therefore they'll have to push on some prices. Already we're beginning to see some degree of tightness around the immigration measures pushing up home construction prices. We have seen, independent of all this tariff-related dynamic on the insurance sector, service prices to go up because of the spate of natural disasters in the US. So even without this tariff, there was chance of inflation surprising on the upside. Tariffs sort of guarantee that for the rest of the year, we'll have a high-pressured economy on the price side. But would it be a high-pressured economy on the growth side? Very unlikely, because the uncertainty that is coming with tariffs is having a paralyzing impact on the investment environment in the US. So you'll have one hand, the White House announcing almost on a weekly basis, hundreds of billions of dollars of investment plans by Japanese and Korean and Taiwanese companies. But I have a feeling that none of those things will materialize in the near term because you need the dust to settle, because even those companies which really want to get along well with the US, the fog of trade war is so thick right now that a board to go ahead and execute a multi-billion-dollar investment plan in the US right now is very, very unlikely. So lower growth, higher inflation, not a recession, not 70s style massive inflation, none of those things, but certainly on the margin, slower growth, on the margin, higher inflation, and hence I would call it a stagflation light scenario.
You think, Taimur, what is going to be the key right now is going to be how central banks actually move in to try and arrest the damage as currencies also adjust to this new normal of tariffs across the globe? And what kind of monetary policy stance do countries actually take? So tell me, what is your anticipation from the Fed to begin with?
Well, life of the Fed has just gotten immensely complex. They sort of, pivoted toward easing last year, looked really premature, now really looks premature. And then they have pressure from the White House to cut rates, when I think the last thing in the world they want to do is cut rates, because again, the uncertainty around the investment and the inflation environment is substantial. So assuming the Fed can do what the Fed wants to do, not what Trump wants them to do, then the Fed is going to be very likely to remain on the sideline, but perhaps start doing significant tapering of quantitative tightening, because in times like this, there is significant additional need for liquidity globally and, of course, in the US. Now, in the past, say 2007, 2008, when we did have a global financial event, the Fed acted as a massive backstop for global liquidity. It, on an urgent basis, signed a bunch of swap lines with key emerging market and developed market economies to assure the world that there'll be ample supply of dollar if indeed we have some sort of sudden stop in flows because of a financial instability reason, or in the current context, because of the uncertainty of trade war. My fear is the Fed will not play that role this time, will not play a soothing, mature member in the global financial landscape to assure the whole world that there'll be ample supply of liquidity. That could create some problems going forward. So I'm right now, of course, the key questions are around tariff and inflation. We need to be very cognizant of the financial stability risks around that and the role that the Fed has traditionally played. Will that role be repeated or not? I am a little concerned that may not be as constructive a contributor to global financial stability as they used to be in the past.
Okay. Taimur, what US administration is doing is that first it's an iron fist, then it's an olive branch. Then it's an iron fist, then it's an olive branch. Then it's iron fist, then it's olive branch. The iron fist has been punched yesterday. Now do you think it's a matter of olive branch, which is tariffs would be much more diluted by the time they are actually rolled out?
Yeah, I've been looking pretty hard. I haven't seen too many olive branches so far. I've only seen the fist. Um, I mean, I think that the modus operandi of the US administration is that their disproportionate strength on global trade and commerce and capital flows is such that they don't have to offer any olive branch. Look at the government of Japan's response to the tariff announcements in the last few hours. They are not willing or capable of negotiating or retaliating. All they're saying is that they're disappointed and they hope for exemption. That is exactly what the way the White House wants the rest of the world to behave. Bend your knee, accept the tariff, offer all sorts of goodies to the US, but that doesn't mean the US would necessarily quote unquote reciprocate. The Mind you, all these tariffs that have been imposed today are not a forward-looking measure. These are, in their words, to redress the injustice done over the last 10, 20, 30 years. So no matter what you do today as a partner of the US would necessarily allow you to find some justification in getting those tariffs to be rescinded. That is a whole different ballgame of how things go forward. But these are for correcting the previous norms. So I have a feeling that there are many countries in the world who will see zero olive branches coming from the US. Now, pharma sector, electronics, things that really matter to the US consumer on a day-to-day basis, we might see some exemptions, but that already has been there. We don't have to see a new olive branch around that. But on countries like European Union, Japan, Canada, Mexico, countries who have always been allies of the US, I am not too hopeful about many olive branches.
Taimur, at what point in time world will get worried about the leverage in the system? Because what worries me is not the slowdown. What worries me is that when the slowdown will happen, the leverage which has got bloated because of money printing, that could come and bite us. How far are we away from there? And is leverage in the system a real problem?
The Federal Reserve of the United States published a financial stability survey in October, November of last year. It's a useful read because it looks at the fault lines in the U.S. economy after 2 years of high interest rate. Where were the incipient areas of stress? Now, looking at the U.S. economy in November 2024, things didn't look that bad. Household leverage was coming down. Public sector debt was high, but household leverage was coming down. Corporate sector balance sheet was strong. Bank capital adequacy was substantial. But there were signs of things cracking under the surface. At the subprime level, credit card loans, auto loans, mortgages, personal loans, delinquencies were going up. When we look at hedge fund related leverage, they were substantial. When one looks at the private space, private equity, private credit, substantial accumulation of assets, not necessarily mark to market, and most importantly, the duration risk that US corporate and financial sector have with respect to holding the US Treasury. If we are heading into a stagflationary scenario in which we have a growth slowdown, but at the same time, around high inflation expectations, rates at the long end don't come down any further, then that huge leverage that we have at the government level, particularly, but also in financial sector level, could come down to haunt us. And this is where I go back to my point. The liquidity question comes in very importantly. We don't want a liquidity crunch to become a solvency issue. But my fear is that going into tomorrow, the day after, there will be companies around the world, in the US, elsewhere, whose leverage situation and exposure to trade war will intersect in a disorderly manner.
So, Taimur, at what point in time do you think the slowdown in the world will start having an impact on the global financial stability? Today, what everybody is talking about is the fact that, okay, China slows down, US will slow down. It's manageable. It may lead to some asset price dislocation. It is manageable. But at some point in time, if slowdown becomes shriller, it will start impacting the financial stability. Could you see that happening in this leg of decline?
If during the course of the second quarter, we start seeing immediate inflationary impact of the tariffs and we see the impact on inventory, we will start seeing financial stability issues. Right now, when when the US wakes up, we will see the US financial markets throwing a tantrum. But I don't think it'll become a systemic issue tonight or tomorrow. For that to happen, we'll have to basically see the destructive nature of trade war by way of higher inflation, by way of huge curtailment of consumer demand. That would materialize in the next few months. Right now, the soft data, expectations, business decisions, those things are showing distress, but the hard data, they're not. Labor market data, by and large, is still pretty good. Housing data out of the US is still pretty good. If they start turning south through the course of the second quarter, the financial markets, which in my view so far has been pretty complacent, despite what we're seeing in the futures right now, to me, it's still a fairly complacent, this too shall pass type of mentality. That will be severely challenged by the time we're in May and June.
And Taimur, finally, to wrap it up with one final point, supply chains will change. Now, whether Vietnam moves to Bangladesh or Bangladesh moves to India, supply chains will change. How do you think that will have an impact on the future investments at a global level? Because now entrepreneurs would think, oh, where do I invest? Why do I invest? And how do I invest? That automatically will delay decision making.
I think that, oh, by the way, Bangladesh also has 37% tariff. I just saw that. The immediate implications are twofold. One is, how do you do business with the US? And then how do you do business with the rest of the world? I think these developments will push the rest of the world closer to each other. 6 months ago, if you and I were discussing about the prospect of a European Union-India trade deal, we would have been fairly pessimistic. It wasn't really going very well. I think these developments turbocharge that. India, China, Global South within each other, ASEAN, everywhere, I think people will hunker down and try to figure out ways of keeping their risks separated from the risk related to the US. US is a large consumer market. It is 30% of global GDP. You want to be exposed to the US market, but if it becomes prohibitive to business, it's not the end of the world. The 70% of the rest of the world's demand are still there. Some companies will migrate to the US. They'll sell there and protect their market share to some extent. The Japanese did that in the 80s and 90s. Maybe many others would too. But the rest of the world would have to basically figure out ways of finding profitable ways of doing business without the US as well. US is not the be all and end all. There is a big world out there.
Before we let you go, just one more question on how you see actually the dollar and the dollar index adjust to this new world order.
Very sort of push and pull dynamic right now. Tariff immediately should leave salutary impact and maybe see some organic appreciation pressure against the US dollar. But by and large, putting everything else aside, tariff should mean strong dollar. But because of the additional complexities right now, they will cancel each other out to some extent. So we're not that particularly bearish or bullish the US dollar right now. DXY largely flat in the second quarter of this year.
Well, Taimur, you've been very candid. You've spoken about Iron Fist, olive brands, stagflation, economy, India. I loved your thoughts and thank you for joining us.
Pleasure as always.
If you like this video, then like, share and subscribe to ET Now.